So a very exciting topic, startup IPOs. We have in the past 2 years, we have seen a dozen startup IPOs and a dozen are waiting in the wings. From MobiQuick to Mama Earth to Ola Electric, at least a dozen are in different stages of IPO filing and listing. And we know that, so from Zomato's trailblazing IPO 2 years ago, we had Nykaa, Policy Bazaar, Paytm, and so on. But the startup IPO party was short-lived. We had a tech meltdown, and then, of course, so many of them are in the process of recovery now. They are all recovering their lost grounds. So in this context, Rahul, I'll start with you. So this eventful cycle, we see that the narrative has changed to profitability, sustainable growth, etc. But as far as early stage VC investing is concerned, we know that it's all about blitz scaling, and all leading VCs, including Lightspeed, you have many high growth companies in your portfolio and which have seen varying levels of success and challenges. So in the changed context, do you see that the approach to the early stage investing has changed?
Thank you, Manu. Thanks, first of all, for having me here. I mean, look, over the course of the years, while markets move from one format or one phase to another, I will say at the essence, early stage investing is a very simple trade, which I think we end up complicating most often. I think, and the simplest thing that we have to look for is outstanding founders building in very large markets with potentially a very differentiated idea to start off with. And I said potentially differentiated idea because at the beginning, perhaps it's not that apparent, and over a period of time, it becomes apparent. Now, whether you are blitz scaling, whether you're burning your way through, whether you're being conservative, all of these are layers on top of it that we apply. But at the very core of it, it's a very, very simple judgment that you need to apply before investing money into that company. So I don't think the core has changed at all. I think the core remains the same. I think both investors and founders are much more cognizant of where the private capital markets are today, and therefore they pace themselves accordingly. But yeah, I mean, one could argue, for example, Snowflake, which is one of the large listed SaaS companies in the US, valued I think somewhere like $50–60 billion, is still losing money, right? But it's still very highly valued because they're losing money because they're investing in growth. The core business makes money. So then you start sort of, you can, double click into everything and justify everything. But at the core is, are you creating a new business in a very large market? If you are, then yes, of course. Yeah.
So, okay, the core hasn't changed. So from early stage investing, so I'll shift back to IPO, which is the central theme of this debate. So in the past 2 years, as we have seen, Sumir, so of the 12 companies which are listed, 12 startups, so 8 are trading below their IPO price now, and only 4 are trading above. So this has been a roller coaster ride. So what are the learnings according to you in the past 2 years?
Can you hear me? Yeah.
Yeah, sure.
Yeah, so I think there are obviously lots of learnings out of this, and I'll actually build on what Rahul was talking about. I think the issue is not so much about whether it's profitable or not profitable. I think that is an issue because the market want profitability. That's the key, but they also want growth, right? In the early stages, when a company is raising money, all that matters is growth and getting the product market fit and the unit economics right? But when you come to the public markets, they prefer a higher maybe a higher percentage weightage to profitability.
Yeah.
I would say. So if you look at the regulations that are there, the regulations actually allow I wouldn't say a company which is not yet making profits, I'll put it in a positive way, to still list, right? Sure. It's just that they basically say that if there are 3 criteria, either you have to be profitable for the last 3 years, all 3 years, your net worth should be at a certain level, all these 3 years, and your book of assets should be of a certain size, all 3 years. If you meet them, then it's a normal IPO, which means you have that split of institutional investors, HNIs, and retail. But if you don't meet it, then obviously this is something where there should be a higher weightage for institutional investors, and so the weightage shifts to institutional investors, but you still can go through. That's how Zomato and everybody else went through, right? So I agree that yes, the weightage is more for profitability in an IPO situation, but I think there are 2 more fundamental things that are more important. I think one is predictability. So look, I think I'm also guilty of it, working in early stage companies and growth stage companies. When we talk to investors and we give out numbers, those numbers are taken as more intent than actual hopefulness of achievement. Right? It's more directional, right? And don't shoot me for this later on, but that's reality. But that's not the case with the market, right? With the public markets, when you sit down, the guy will open his notebook and he'll note down the numbers you told me, right? The next time he meets you, he's going to open the same book and ask you, "Aapne ye number bola tha." I can allow a 2% variance. That's it, a 2% variance, not more, right? So if you're off that, then they start losing confidence in you, right? So you can still be loss making, but you've got to be on the line. And the last is actually and I don't know whether this will happen more and more or lesser as such. Your model should be fixed actually. You should know what business you are in actually, right? So, if you take the case of Zomato, it listed at a price, went up to 115, and then, they did Blinkit, and the question that was being asked is, hey, I invested in something that's in the food delivery business, and now you change it to the raw material to the food delivery business, right? So I didn't invest in this. I don't know the market size of this. I haven't figured this out, right? And it dropped to 44 rupees, right? In June 2022, it was down to 44 rupees. So you cannot go to a market where you're going to, M&A is fine. M&A is completely acceptable. But M&A, fundamentally changing business models of this nature, pivoting, that doesn't work for the market. Okay.
So public markets have got stricter parameters. You will be held to your word. So Jasbir, in RedSeer's report, you have put out a very optimistic scenario where 40 companies are going to be, in public, 40 startups are going to be in the public markets. So that's kind of a 3.5x jump from a dozen that we have right now. So what are the driving factors to this phenomenon? So we would like to know.
See, in our case, what we actually see is there would be at least 100 odd companies in the next 5 years who would probably have the right metrics. Yeah. Whether they decide to list or not is a separate matter altogether. And by the way, I do side with what has been said here, that maybe the founders understand the VC ecosystem a lot more. That you're trying to sell, oh, there's going to be a rainbow, it's going to be large, see the colors are going to be just right, they'll be in the right sequence. And we all know that, at the end of the rainbow, there is a pot of gold. But when you get to the public investor, he wants to see the real pot of gold, not the rainbow. And he wants to see that the pot is growing. So what we are saying in our report essentially is that there would be 100 odd these companies which would have figured this out, right? And it is a combination of, let's say, whatever has happened last year from these 12 odd companies which have gone public, corrected the valuation, and maybe MobiQuicks and the next ones which are going public or soon go public. They would set the tone for what to expect, right? I think largely that is what we are trying to say. We are not pinning our number to 40.
Yeah.
We are saying, oh, this is probably 100,
Yeah.
which is just going to be right.
Okay, got it. Okay. Vinay, so while we talk about the public listing that has happened, so there are several positives too. One is of course, all these companies across board. We have seen that there is a remarkable improvement in their financials, be it top line or PAT. So what is actually really playing out? So is it that since the public market demands a higher degree of transparency, that has enforced certain financial discipline, that's why they are showing profits? Or is it that these companies were even otherwise fundamentally strong and now the results have start showing? So how do you interpret this? Yeah.
So I'll take both types of companies. At least in the last 2 years, at least 2 or 3 of IPOs I have taken through, right? And then on the tech side. So the ones where we have taken through IPOs, mostly non-tech, have done phenomenal businesses. They were great earlier, they were great now. In between, we had a COVID period that did depress stuff. 2 consumer businesses we took public. And I would not say that, because of the higher scrutiny, the financial books have gotten better. No. I think when we are on the boards, we drive corporate governance and we drive a good set of reportings. Not only financial reporting, but we also drive a lot of operational reportings as well, right? Now what happens is, of course, the mindset does change, which means that public market investors, as everybody else said, wants profitability. And therefore you have to take decisions where you move further, easier, closer towards profitability. What do? Where is the losses occur? The losses occur in experiments, right? You take new experiments. Second, the losses occur in growth. Third is the losses occur in the acquisitions which are loss-making, right? So if you look at Zomato, I think it sold off its portfolio in a couple of countries. Those were loss-making. What do you do then? You cut the loss, the net profit goes up. In a retail business, what do? All your loss-making stores, if you take them out, your overall profitability goes up. So it's the operational discipline and understanding what to do now. You are no longer a child trying to run a startup. You're a mature guy going to a job. In college and school, you can do something, right? In a job, you'll be fired, right? So that's the transition that occurs from an early stage to an IPO stage, yeah?
Yeah. Okay, so Akhil, so the rest are all, except me, all are investors and, iBankers, and then you are the only founder. So, unicorn founder for that matter. So, we would like to know your IPO preparations and also, about your profitability journey. So, some of your numbers, I think, we would like to have some visibility, the last 2 years.
So so I am the sole guy battling for the founders here. But so to give the idea, NoBroker is around 8.5 years since we raised our first round. And unlike all other companies or many other companies, in real estate, you can't throw money and make business grow. So it will not happen that I'll give you 100 rupees off on the order and please order from me and get the food or the groceries from here. And typically, if you see, not only for real estate, what I believe fundamentally, it takes time to build a business, correct? The things which are slow and steady with a solid foundation, they sustain long, they are the sustainable business. If you can make something which goes up very fast, it can come down very, very fast also, like a deck of cards. So fundamentally at NoBroker, we have always believed in building a long-term sustainable business. And the challenge with us was we were challenging the status quo also, because the way we have built the business, it has not even done across the globe. Forget about India. Nobody has ever tried to do that particular thing. And in this last 8.5 years, what we have been able to do, real estate is a big TAM, correct? But we started as a rental, then we realized that the same set of customer, they want to buy properties, they want to buy primary properties, they need help, because India is a low trust economy, correct? As a overall, not only in real estate, everywhere it's a low trust thing. So NoBroker has been able to create that brand, the trusted brand in real estate market, where people say, acha, yahan pe kar sakte hain. And that opened up a big opportunity which was much more humongous than what we thought when we started. We thought we'll do the transaction on the platform, take a subscription fees, small fees, make money out of it. But then people started telling, why don't you help me with rental agreement? Why don't you help me with packers and movers? And because I am sitting on the transaction, when I know that person A is moving into this house or somebody is selling the house, I can help them with cleaning, painting, legal. So that's how the business has grown. And if you see, there are multiple businesses at NoBroker. There is a one core real estate business which is profitable at the city level. If I break NoBroker into multiple pieces, there are pieces which are profitable, earning, generating cash for us. But what we have decided to grow the complete market. So we are taking that cash along with what we have raised, investing in different businesses. Like if you talk about home services business of NoBroker, that is 3-4 years old business. We have financial services where we are helping people with the loans, the payments and all those things which is happening. We started something called NoBrokerhood, which is a society management bit of it, because we feel that if we are in life of our customers early, when they are living in those apartments, we can help them do the transaction at the right time without having to acquire them later. So I believe that company has to eventually be profitable, because agar dhanda profitable nahi hai, to what exactly you have done? It doesn't make sense. And every company has its own journey, correct? Just because, and this is the third cycle what we are seeing in our journey, 15, 18, 21, 22. Just because somebody says, okay, and this is a marathon what you are running. Somebody says, okay, now funding winter has started, become profitable. It doesn't happen that way. You are running a race. What may happen in a marathon, you can take a breather, stop, decide, okay, I may want to change the pace at which I am running. It can be a little slower, it can be a little faster. But rato raat profitability nahi aati, correct? It's a journey. And like everybody else, and nobody in India, I'll say nobody wants to make a business which is not profitable. Why will somebody build a company which is not profitable? Until and unless somebody wants to siphon off the money, and which may be the plan with which they have raised the money, which is totally different thing. So same way, NoBroker is also gunning towards profitability. Our numbers are growing. We have got into the 4-digit annual rate of revenue now. And as I said, part of businesses are profitable. We intend to be profitable in next 18-24 months. And eventually, at some point of time, we'll have an IPO in the market.
Okay, yeah. So that's yeah, best wishes to that. Okay, so, okay, Sudhir, in your long career, straddling both public and private markets, want to understand, so if we look at the dozen IPOs that we have had so far, of course, there was a meltdown, but now some of them are actually recovering the lost grounds. In the past 6 months to 1 year, some of their, stock price have doubled, in fact. So I certainly regret missing the opportunity to invest in that time. So I would like to know, so how do you see, what are the factors at play here? Yeah.
Well, I think as investors, and each of us is an investor, you can invest in a fixed deposit and get 6% from a bank, but then you expect that 6%. When we're investors in early stage equity, or we're in public market investors, I think we wear a similar lens. We want a return, we have a certain time horizon, and we're expecting some liquidity, which means when I want to sell, I need to be able to sell it in that time frame that I'm choosing. And when we're theoretically building companies, as early stage venture investors, we have a different lens, because we're also deploying connected talent to the management talent that is available within an enterprise. In a public listed company, we don't normally hear about it, but they have consulting, they have advisors, they have board, etc. That VC plays that initial role. If you want a return that you're talking about, chasing a return, a certain price point, and hope to enter and exit with a return, public markets, we have the opportunity of relative investing, which is everything's liquid. So I can sell first and buy later. I can short the market. And basically, this process that we use there is about the understanding of what might happen in the next future, right? Future as day trader would be in the day. A weak trader will be in the weak, a settlement trader would be in the settlement. Long-term sovereign investors could take a 20-year view. But the lens we wear will be based on what kind of capital I'm deploying, for what return, for what risk, and what reward I expect. And I think when we're in the Soonicorn and we're in the private market space, all of us, mostly, I think the differentiator really is that it's illiquid. The asset class, by the nature of it, needs to be formed. It's in a formative state. It's not ready. It's not cooked. It's not saleable or consumable. And in that context, there is a gap between the effort and even an output, forget about an outcome. That needs investing, capital and time. And I think what we do basically around this table is pick a potential. It could be an idea, it could be an existing business, badly run, can be improved, so on and so forth. It could be deep technology, where the technology does not exist. So therefore, we need to build these technologies, and that's where we invest. And you then wait for an output. Every effort needs a certain sequence of events. You wait for the output may be good or bad, we don't know. If it's good, then we can do more of it. And then we look for an outcome, which is actually beyond just the outputs that we measure. So an Idea Forge, which we just recently took public, if I went back, dialed back 7 years ago, IIT Mumbai, as they were called boys, they're still called boys, because they were the guys who put that VTOL in Three Idiots, and that's how they were, from the dorm. But some of us who are, have been around the system, we realize that there's beady-eyed, you can do stuff, you can build stuff, but when you say, let's do it in Ladakh, I don't think even the army knew what the trials would entail. Forget about us producing it. Neither the consumer, nor the producer, nor anybody actually is aware. So those potential outputs which can be zero are factored when we're investing in our risk-reward plan. And to your point, then to take that to a sustainable, rigorous, repeatable business, and then let a sovereign fund take a look at you, or a mutual fund. You are investors in mutual funds. 25 years ago, when we launched the mutual fund industry in India, nobody was a buyer. What is mutual fund? Today we have $600 billion of savings in mutual funds. And every asset management company is, spitting cash, if you may. So, and they're listed also. Yeah. So I think this journey that investor classes will expect different kinds of shades, different aspects of what drives them, should also be in our minds when we're founders. I'm a founder of my own company, for example. He's not the only founder there. I'm a founder of our asset management company. And therefore, as founders who are building businesses, I think we have to realize, do we want liquidity? Do we want a diverse set of shareholders? Are we happy with 2 shareholders, 10 shareholders? Those are dictating more whether we have to be listed or otherwise. And therefore, the preparedness and the strategy for meeting those objectives then vary.
Sure, okay. So, Rahul, as we discussed, about a dozen are waiting in the wings as far as the IPOs are concerned. So, after a lull, I think the startup IPO is again seeing some action. Some even, in your portfolio as well, Lightspeed portfolio as well. So, how is the startup IPO landscape looking like?
Look, at this point of time, I would say this is the second phase or the second set of people going off the blocks, right? So it is as defining a moment as the first one was, right? And I think the first ones were sort of, let's say, the leaders or the first guys who started off in what I would call Internet 1.0 of India, right? And then took it to a fruition by taking companies to IPO. Now we are in the second phase. Progressively, what you are seeing is, like in private markets, even public market investors evaluating these companies very differently, right? I mean, there is a BPC company which is in the process of going public right now. Hopefully they'll list in a couple of days. And a couple of years back, people would value a company like that like a tech company. Today they value the company like a CPG company, right? So you see how even the benchmarks in the public markets are moving, right? So I think there is much higher awareness within the founder and the private investor community about how to think about IPO for these companies. That's one. Second is, I think Sumir mentioned this. I think there is appetite for companies which have a path to profitability, even if no profitability today. I think that appetite is building. And third, I would say that interestingly, people are realizing that is not the end game only. I mean, there are multiple ways of generating returns for people who've been early investors in your company or for yourself who've been around for 8, 9, 10 years. There is a large building secondary market in India as well, right? So, I mean, all in all, I will say, look, the first generation of startups in India, like I'll say, make my trip, the US to India business was 1999. We are what? Like we're 23, 24 years old. We're not even a quarter of a century into this business, right? So it's still very, very early days. And I think like personally speaking, the fund that I work with, we are massively optimistic about where this is heading. So yeah, I mean, I will say good things in store. Each company will go through its own journey. And yeah, I mean, lots more to come.
Yeah. So, and the exit scenario is actually looking more promising than it used to be. That's what.
I think, A, it's looking more promising. B, I think people are a lot more intentional about it. Previously in the private markets, I think because this was the phase where people were investing still, right? I think in the life cycle of a fund itself, it was very early for people to start thinking about returning capital. But now, as many funds are maturing and approaching the end of their life cycle, I think people are becoming a lot more intentional. And I think the smarter founders are cognizant of that and they help engineer things around that.
Okay. Yeah. Sumir, so you meet a lot of early stage companies, very early stage companies, and they're, of course, neither fundraising or maybe trying to sell in a long bearish cycle that we see. So, and then, so now we are talking about IPOs, that's maybe, some 10, 12 years away for these companies. So, but are they fundamentally building to be IPOable at some stage, so among the companies that you meet, what's the sense that you are getting at a very early stage you work with?
Yeah, I don't think there's fundamentally any difference in the way early stage investors would look at businesses or late stage, right? I think the level of risk that a Celesta Capital is willing to take on when he looks at a deal and the risk that the later stage investors are willing to take on is a difference, right? And there's a risk reward involved with that. But I think what happens as you go forward, obviously, is that the business models fall in place. And when you come to this stage of investment, you know your business and you are sticking to growth in that business, right? So essentially, it is a lot more deliberate, right? And I think when companies come to this stage, they actually need some help to understand how they need to change their mindset, really. It's a very different mindset in dealing with this class of investors, which is, it's almost like a chasm. You have to cross and you need some help, right? Because like I mentioned a little while back, when you go for these meetings and you give a number, in early stage investing, in growth stage investing too, you're giving an intent statement. Here it is a number. So you can't be off 2% from that in that sense, right? So it's almost like the CEO has to be coached on what and how he should interact with these people.
Yeah.
They are not going to change. You got to change,
Yeah.
right? And then, of course, internally there have to be a lot of changes done. You don't have to plan for those things at the early stage of business. I think you have more fundamental things to target, like figuring out your customer segment, your product market
Yeah.
fit, and your unit economics.
Yeah.
Figure all that out, and
Yeah.
this can be figured. But there is a lot of work to do.
Yeah, you have time.
3 years before you go IPO, there's work to do.
Okay, yeah. So I'll go to Vinay next because, it's a related question. So you invest in very early stage, basically, like, so, I don't know whether IPO figure in the scheme of things at that stage, but, what are the conversations that you have at that stage when it comes to the long exit horizon that you have in mind? Yeah.
Sure. I mean, first of all, I've done late stage, like a buyout funds. I've done VC stage, growth stage, early stage. So I mean, I've been fortunate enough to have done all, right?
Okay, yeah.
So at IPV, we do early angel and seed as well, and then a little bit of growth through our Merisis Capital fund. So I think your question is mostly very, very early stage, idea stage, pre-revenue stage. There we look at, can this founder really take the company to the level where it can go, right? So as Rahul said earlier, the quality of the founder is very, very critical. His ability to execute, his ability to think through, his ability to build a team, his ability to have a technical sound knowledge, his ability to handle so many stakeholders, board, employees, vendors, and so on and so forth. So that is very, very critical for us. Yeah. So the second part we look at is, can the business really grow that big, right? Our horizon, typically early stage, the benefit we have is we can actually hold it through IPO. We don't have any, as an angel, we don't have any time horizon. Yeah. We don't have any end goal. We can hold for 10, 15 years, right? Okay. So when we, for example, invested in Milk Basket, very early first check.
So we are running out of time. So
so similarly at Bharat Pay, the first check, we could actually see where the business could go. Okay. So we do look at long term, but we are happier to take it earlier as well. Yeah.
So I'll quickly go through, so a couple of more questions basically. Akhil, so you're a consumer internet company. So many consumer internet companies have now got listed. So now your customers have got a chance to be your retail investor. So does the customer experience, play a factor when it comes to your public market performance? Of course, you're not listed, but I'm saying, generally, what's your view on that?
No, it has to. Without customer experience, forget about public market, you can't even run the business. So if you don't have a product which is loved by your customer and customers are vouching for it, you can't do anything. Because these customers, and for a B2C company like us, when we go public, people who are our customers, if they have had wonderful experience, they only will go and buy our shares from the public market. So customer experience is paramount for any company.
Okay, so we'll end with Jasbir. So it's not 40, it's 100. You said, so by FY28, what are the segments and sub-segments probably we can will dominate the startup IPO scene? Yeah,
I think the broader strokes still remain the same. About 35% of these would be consumer, whether they are product or services. Maybe another 40% is a fintech or a SaaS looking company. And a B2B segment, right, which is either on the manufacturing supply chain or logistics side. I think that is how we picture it, right? Given the pool of startups which have scaled to a certain level, right, we see about, broadly these sort of companies should come out.
Okay, yeah, sure. So the last question, so to Sudhir, very briefly, basically, so want to understand, among the listed startups, so if you look at IdeaForge and MapMy India, so which were probably less celebrated in their pre-IPO stage, have done probably much better on the bourses. So what are the takeaways? Is there any learning, what worked and what did not work? We'll end with that.
I think basically public markets, when they look at a new company getting listed at that phase, don't forget, I've seen 2,000 public offers in my life in the 90s, a 10-year period. And at that time, there was no venture capital industry. The street was the venture capitalist. You put up a prospectus, and then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to come. And then you wait for the company to I went to Reliance Petroleum. It was a sheet of ground, nothing there. And we invested in it, Reliance Petroleum. So now it's a big refinery, etc., one of the world's largest refineries. But to your question, when public markets look at investing in a company that's getting listed, they want to look at, and again, I would wear the lens very differently. There are anchor investors, there are sovereigns, there are day traders, there are mutual funds. Then there is small cap, mid cap, large cap. So the investor universe is fairly deep. That's one thing you have to understand. We have a $3-4 trillion market cap there. We have 150 billion in VCs. So it's, it's chalk and cheese in terms of capital put, capital available. So you have different lenses. Now for IdeaForge, and I'll just speak from our perspective, I think what appealed to public market investors, and this is today, is there's a secular trend on defense. There's a secular trend on differentiating deep technology, which defense actually purchases. Very long procurement cycles, very high barriers to entry, because it actually takes long to get inside. Any defense anywhere in the world, for that matter. It's not just India alone. Third, it was an asset class that was emerging, which are drones. You asked him a good question. Is there a retail appetite? And there was an appetite because every shadi, this hall in the evening, will have a drone over here. So nobody could not understand the importance of a drone. They understood it, they got it, they understood the word. But I think what institutional investors were looking at is margin profile. What is sustainable barriers? What is sustainable margin? And then dual use. So when you look at pure defense and then you look at commercial application, which most defense companies have done, you're going into those aspects. I would say that investors, from a consumer, like a retail investor, to an institutional investor, wear it differently, and the companies that go public must think that, because they're a very diverse set of shareholders.
Okay. Yeah, sure. Thank you. So, thank you for, yeah, sure. Yeah.
Sorry for butting in. I actually had a point, I missed covering that. I just wanted to say that, when I think this move that's happening is actually very good for all of us in that sense. When I started doing this business of investing, investment banking, advising entrepreneurs on the journey, the reality is that when they write up the SHA, it's written that in 5 years' time, you're going to get us an exit, either through an IPO or whichever way. And if you don't, then we can drag you and sell you, right? I mean, the whole logic was that the fund life is 10 years and we need an exit. But the reality of what we've learned after that is that the lifetime of building a company is actually 15, 20 years. Okay. So there's a sort
difference.
Of a mismatch here. And companies, why should entrepreneurs be forced to sell their companies just to provide exits? I think fundamentally what's happening with IPO markets is that, and that's why I actually insist on that point, that it doesn't need to be profitable. So long as you know your business model, you can actually go to IPO, get exit for your investors, continue to hold on to your company, be the owner. Why should you exit? And actually, and I can cover that in greater detail with people who are interested, it's an easier way to raise capital than raise private equity. Okay.
Yeah. Sure. Thank you. So, well, that has been such a long session. So, and we are coming to an end. Thank you for patiently listening to the session. You are a great audience. Thank you.